day, traders, and welcome to another edition of the premium video newsletter for September 12th, 2013. Everyone was expecting volatility during the second half of the week, but it looks like we got it backwards this time around. Either way, there's lots to discuss, so let's jump right in. The Department of Labor said earlier that the number of individuals filing for initial jobless claims in the U.S. fell by 31,000 to 292,000 from 323,000 in the previous week. Analysts were expecting the number to rise by 7,000 to 330,000. This is close to the lowest level since 2006. This gave traders and investors further assurance that the stimuli program is in fact going to be cut very soon. As we discussed many times before, monetary stimuli programs such as Fed asset purchases weaken the dollar to spur recovery, which makes gold an attractive hedge. And now it looks like the stimuli is beginning to tighten once again, and gold is feeling it. We called the top a week ago, and I anticipated a good-sized move on the way down. So far, our analysis of this market has been very accurate, and I believe weaker prices will continue. The whole reason why gold went up was the imminent fear of war, and right now the market is not seeing it. So we're back to the fundamentals as we anticipated we would be. Right now, what we're seeing is selling by the same buyers that entered the market on the way up last week. There's many sell stop levels on the way down to the 1300 area. I'm anticipating the selling to continue into tomorrow because the range is wide, and that tells me that the selling is in fact very emotional. Let's see if we can get close to the 1300 level and go from there. The next market I want to look at is the bond market. Remember what I always say, and I actually said it yesterday as well. Markets revert back to their trend for the most part. This is how trends work, and this is how professionals trade. We saw a few weeks of fundamentals that were contrary to the trend of this market. I'm talking about Syria right now. But look at what happened when the threat diminished. We reverted right back to where we were before Syria was even in the picture. We also had a mini island reversal yesterday, which suggests more downside pressure for this market. The bonds are focused on next week's FOMC, and unless the Feds tell us that they are not doing anything at this time, we are going to break down another level. Remember, bonds are choppy, and you will see a lot of range-bound and counter-trend activity, but overall, expect further downside movement, especially if Feds take action next week. I want to talk about crude oil for a minute. Syria is not a major oil producer, but oil traders say the possibility of a wider conflict could interrupt production and shipping routes in the Middle East and cause prices to rise. But now there's no certainty of that, and the market is reflecting this very accurately in the current trading range. Most of the time, symmetrical triangle patterns occur either after a long trend, when the markets pause and run out of steam, or conversely, when there's an event that's going to take place and traders are split on the outcome of that event. In this case, if Syria causes more problems, it'll have a direct impact on oil and will cause a breakout to the upside. This is consistent with the pattern because symmetrical triangles are continuation patterns. But we have to remember one important fact. Immediately before Syria came into the picture, I remember coming to the conclusion that oil has topped out. If that's still the case, then a breakout to the downside from this triangle is very possible and likely. If nothing new comes out for the next few days, the triangle should continue getting tighter and tighter. This will create more momentum if and when we break out. Let's continue watching Syria for clues to determine the direction of the move at this point. The US dollar broke yesterday's low today, but with less volatility and less downside momentum. I pay attention to the daily range as much as I pay attention to where the markets closed compared to where they opened. and today's low is telling me that we're not out of the woods just yet. Today I'm seeing more uncertainty compared to a sell-off, which is what we saw last few days. I'm still expecting more downside selling pressure and conversely a bit more upside in the foreign currencies such as the pound. Right now the equilibrium between buyers and sellers is fairly even, so expect some choppiness and possibly a few days of random market action as the market is preparing for the FOMC next week. Expect the same for the foreign currencies as well. No one wants to make big bets before the FOMC, so we're in a holding pattern for now with much uncertainty. Let's discuss the stock market. As I mentioned yesterday, the Nasdaq saw divergence between the RSI oscillator, and this alerted us to the fact that we may be approaching slightly overbought levels. This is no surprise considering we had several strong up days. But here's what I'm seeing with the Nasdaq. Even though we have divergence and I have full faith in my RSI oscillator, I'm seeing the last few days stay very close to the top of the range. Typically, when emotional buying takes place, instead of real long-term accumulation, the selling that occurs afterwards is quick and fast. The markets typically don't stay up near the high levels, but more often than not, go back to the pre-rally prices. But the market is holding pretty well right now. So this is telling me that although we are correcting, the correction is very minor, especially in light of the rally we saw and the level we're at. For now, I'm bullish, but I think this market is also waiting for next week's FOMC. Watch the bars during the next few sessions and notice if they're moving down a lot or staying near the top. If they continue to stay near the top, I'm going to become even more bullish in the tech sector. The other sector we want to pay attention to right now is the Russell 2000, and it's not confirming Nasdaq's move, not even by a long shot. This was the sector that rallied to a new high first, and it's the first one to sell off. What's worrying me a lot is the fact that we're seeing a double top with the second top lower than the first one, so it's legitimate. This index tends to lead the broad market, and the broad market is looking very similar to the Russell right now. If the Russell begins really moving down, and it looks like it may, it will have some negative impact on the broad S&P market, and that will cause the Nasdaq to pull lower as well. So if you see a drop in the broad market, a real drop, don't be surprised to see the Nasdaq follow and fall quickly from all-time highs. The last sector we want to look at to confirm Russell's move is the transports, and this is a subsector we haven't monitored in a week or so. We're above the 50-day moving average, but I'm very concerned by the lack of upside strength that we're seeing in the Nasdaq. Notice that the increase in price on the way up was very sporadic and emotional. We didn't see a smooth run-up in price, and I'm seeing the same thing on the way down. Remember, we want to see what the market does after price moves, and I'm not seeing major strength so far. If we sell off just a bit more, we're going to drift down to the pre-rally price level and fill the gap that we made on the way up. Remember, this subsector is very important to the overall picture, and we're seeing mild weakness immediately after a bullish move. This spells trouble, so we have to watch the broad market for more selling pressure in the next few days. Expect retracement for now to the 115 level, and we will go from there. There's no setups for tomorrow as most stocks are looking for direction and clues from the major indexes, which are diverging from each other as well as having a difficult time picking direction, at least for now. Have a great evening, everyone, and I'll update you tomorrow midday as usual. Expect more of what we saw today going into tomorrow.